Well, the Reserve Bank will make a decision on interest rates tomorrow, with a recent uptick in inflation signalling another rate rise could be on the horizon. The Australian reports middle-class Aussie families are being pushed into financial hardship for the first time as they run down their COVID savings to pay for their increasing loans and bills. And new documents from the RBA also show a growing number of Aussies are turning to credit cards to help cover rising petrol, gas, electricity and housing costs. Joining me now is economist and co-founder of MacroBusiness, Leith Van Onselen. Leith, this will be the first decision by the RBA's new Governor, Michelle Bullock, tomorrow. We're not expecting that there will be a rate rise tomorrow, but particularly when you've got things like the rising cost of petrol as one of the main contributors to inflation. And we know that that's a result of the people who have all the oil overseas basically tightening up the market. There's not much we can do about that. Could there be a rise, not tomorrow, but by the end of the year or early next year?
Yeah, certainly. Look, as you rightfully said, pretty much all economists expect the RBA to remain on hold tomorrow. They are likely to look through the rise in petrol prices, but there is the risk that down the track, we do get these second round impacts from the petrol price rise. So what that means is effectively businesses might start passing on those costs in their goods and services, and that could lead to second round impacts. But at the same time, although the RBA has been on hold since June, average mortgage rates continue to rise, and that's because we've got a very large number of fixed rate mortgages that are still rolling over to these variable rates. So they're basically going from sort of 2% rates to 6% rates. And that process is going to continue into next year. And what that effectively means is that even though the RBA is on hold, the average mortgage rate paid by Australians is going to keep rising. So we're effectively going to continue to have monetary tightening anyway. Now, as to what the RBA is going to do, we don't really know, but they've basically said at the last few meetings that they want to just observe the data. And I think that's the right approach. The labour market's weakening. We've got a per capita recession. Obviously, household consumption and retail sales are falling in real terms. So there is some weakness there, and I think they're just going to take a wait and see approach, which is the right thing to do.
We saw last week the inflation numbers for the month were up, and the RBA doesn't tend to take too much notice of that. They're more interested in the quarterly figures, of course, but it is an indication of where things are at. And you've got power prices up, you've got fuel prices up. There's very little room where we've seen spending decrease because, as I said before, people are now turning to credit cards. So it's not as though people are tightening their belts per se, although many have had to. But people are finding themselves in the situation where just to keep their heads above water, they're going and getting a line of credit. And that in and of itself would also be contributing to the increase or the lack of a decrease in inflation because people aren't stopping spending, they have to spend more.
Yeah, well, I mean, you're certainly right that obviously households are under pressure. We've had real wage falls for pretty much 18 months now since the RBA started to hike, and obviously inflation ramped up. But at the same time, the actual household consumption data that was presented in the March quarter national accounts and also the retail sales data shows that actually households are cutting back. And once you adjust for that inflation, retail sales volumes are actually falling and actual household consumption's actually falling as well. So they are cutting back. The problem is that a lot of the inflation's in these areas that you can't avoid. So, for example, rental increases. So rents are the biggest single driver of inflation, and those are rising at a near double-digit pace because of the huge immigration program. So, and obviously power, petrol prices, all these sorts of things. So these aren't things that households can avoid, but they are cutting back on discretionary spending.
And house prices as well. I mean, they've rebounded across the nation. There's, I think, $336 billion in value has been added to Australian homes in just 3 months. And you saw a rise in property values by 0.8% last month in December, which was the 8th consecutive month of increases. And CoreLogic's head of research is saying that there'll be a new national record for house prices reached by November. I mean, we were talking at the start of the year about a reduction in house prices because we expected, interest rates are going up, it'll create something of a glut in the market, etc. It hasn't happened.
That's right. And look, I'll put my hand up. I was one of those economists who was saying that house prices would keep falling because the RBA is hiking rates. And then pretty much every economist in the country other than Stephen Koukoulas was basically saying the same thing. And it is quite extraordinary. The RBA's hiked rates by 4%, and yet we've got house prices rising. And according to PropTrack, they're already at the previous peak, and CoreLogic says we'll be there in a few months. And effectively, the driver of this is basically the Albanese government's record immigration program, which has basically pushed demand to levels we've never seen before at the same time as supply, both number of homes for sale as well as construction is, at a very low level. So effectively, we are in a very unusual market where house prices are rising against obviously these rising mortgage rates and shrinking borrowing capacity, and it's pretty much down to the federal government's extreme immigration policy, which is also driving up rents.
Yeah, well, I think the RBA's previously said, migration's up 2.5% and the housing stock is up 1.5%. So it's not hard to see what happens in that situation. And as we've talked about before, it's all a bit of a Ponzi scheme. You import all these people to fill all the jobs, but at the same time we want to reduce inflation, but we're driving all the prices up. Quite an extraordinary situation. Leith Van Onselen, thank you for joining me tonight.